Hello and welcome to my presentation on the impact of COVID-19 on markets. I want to take a more of an economic look at the situation. I want to bring in some ideas from economics to kind of break down what has been happening, what may happen in the future based on some ideas, how the financial and monetary policies of countries around the world have uh, impacted the recovery process and what that might mean going forward. Um, in the context as well of marketing and kind of what industries you may expect to do well. Um, so my name is Sebastian Seville. This is for the Responsible Marketing course, and I hope you enjoy. So the first thing I want to bring your attention to is this. This is a chart of the S&P 500. The S&P 500 is an index fund, which means it's an amalgamation or an aggregate of the top 500 companies in the US as selected by analysts and stuff. Um, it, it's neat because it's a pretty good indication of how well the economy is doing at any given time. Uh, so you can see it's generally going up, it's generally going up. And then in March of 2020, COVID hits and there's a huge crash. It went from roughly about 3,400 to about 2,400, which, losing about a third of the value overnight is not great. Index funds are neat because they show they give you a picture into how an economy works and functions and kind of like what the predictions and uh, overview um, of an economic system are going because it's not just one company, it's like it's an aggregate of everyone. And so if you're looking at macro trends, you want a macro indicator, and that's where index funds come in. So you have this huge drop, but then right after you see it bounces back pretty quickly, and the prices go back up, and this might look like things are going back to normal, which is why I brought in this next chart. So this tracks unemployment in the U.S. specifically. So in February 2019, you had an unemployment rate just below 4%. And this stays, pretty constant, pretty constant, pretty constant. And then you hit March of 2020, unemployment spikes way up to about 15%. Now, it does go back, but it doesn't go back as quickly as the markets recover. And when it does settle, you're seeing unemployment of about 6%. Now, unemployment from like an economic standpoint is not awful. You don't want you don't want unemployment to be at zero because you do need some people to be in between jobs. And the way kind of a free market works is that you do need to have people working and transitioning from job to job in order for new companies to be created or fail or function in a free market society. So having people or having unemployment be about 4% is not awful, and countries vary. I think Canada is usually around about 6%, and it changes seasonally as well. Uh, so this is seasonally adjusted, so they've taken out a lot of that variance. So it's staying consistent at 4, jumps to 15, comes down, and now we're at 6. So you would think that the GDP, like the gross domestic product, which is the kind of aggregate sum of value that a society creates, um, would be about 2%. Let's say 2% less because there's 2% less people working. But that's not what we see. We see that the indexes are suggesting that it's much higher. And in fact, this is the highest it's ever been. So the fact that we know that the economy is not doing great, but market prices are at an all-time high should maybe be cause for concern and greater investigation. So that's where this comes in. So this is the amount of currency in circulation in the U.S. So this is throughout history. This is in billions of dollars. So there's $400 billion in circulation in 1994, and at the start of 2020, we're at about 1,800. And in the course of the last year, we've gone up to about 21 trillion dollars. Yes, that's correct. Which represents about a 16% increase in just in like in sheer currency that's in circulation. Um, Now, does this explain all of the price increase? Maybe, maybe not. But it's interesting that, or we can definitely point to this as a driving factor in the price increase, which because um, of this. So this is the velocity of money. It's usually a constant because people usually trade resources and spend on a fairly regular basis. And so prices are tied to this. And so if you increase the money supply, um, or sorry, okay, prices are related to the velocity of money times the money supply over the overall GDP. And so when you have velocity, uh, which has gone down just because people are trading less and less, um, and you have the total productive output, which has gone down, and money supply has gone way up, like 16%. For most people, we see prices as being fairly stable. Like the price of milk has not gone up 16% in the last year. Um, and money supply, I should kind of asterisk. This is incorporating also the not just the like the real amount of currency. This is also like the nominal, I believe it's called money supply. So it includes like the transactive values. Because like if there's only 21 trillion dollars, or sorry, 2.1 trillion dollars in of U.S. currency in circulation, and the fiscal policy, the package that was passed in 2020 by the U.S. government was $4 trillion dollars. So like obviously there's more money supply out there, but that's created through banks um, depositing and then allowing people to withdraw loans and stuff. So there is this is not just the the 16%. This is additive effects of other um, multiplicative factors. But we have because for us the velocity of money has gone down. Um, the extra money and the lower uh, GDP has made prices for us roughly stay the same. In the financial markets, this is not true. The velocity of trading has more or less stayed the same. And so when you throw in a little bit less, but then way more money, the prices go up, right? So there are different factors going on for the financial markets and real world markets. Is the point of this. Um, Aggregate demand has also kind of gone down. There's more saving, but it's been compensated by overall increase in government spending. So less consuming, more or less the same investing. Government spending way up. Like the amount of government spending is honestly quite ridiculous. In the last year, the U.S. government spent more on COVID relief funding than the entire cost of the war in Afghanistan, um, which I mean makes sense because the loss of life had been more than all of the world wars for the U.S. combined. So, fun facts. Um, so, what does this mean for the future impact on recovery? EDC, the Economic Development of Canada, predicts a strong year of recovery, specifically for the U.S., but also for the world. So, sounds good. However, if we go back to the before, we think, okay, recovery's coming, people are going to be spending more money, but suddenly we also have this huge amount of more like way more money in circulation. And so the value of money is going to go down, which is why we have inflation. Um, Now, some people think this is going to cause prices for regular goods to skyrocket. Will this happen or not? Who knows? It depends on how buying patterns settle in a post-pandemic world. If people go back to normal and they start spending things on, like if we get this huge bubble of, or not bubble, but a huge increase or return to like a normal amount of spending, then yeah, we're going to see these prices fly up as the value of money that people have been saving diminishes, and we kind of go back. And does this mean that, like, some of the implications of this are people's wages are likely not going to increase as well, so, or increase at the same rate as prices, um, if, especially if they're not indexed or matched to something like the consumer price index, CPI, which usually it doesn't measure the price of stocks. The CPI is usually tied to the price of goods. And so when you have uh, stuff like the K-shaped markets later on that I'll talk about, where you have this diversion of prices, right here, diversion of prices, where some prices are going up because they're more in value or more in demand, and then others that are not as in demand go down. If your indexes are tied to the products that aren't going down, but then you have people like other prices that are going up, you end up in this situation where your model and your system doesn't necessarily, it's not necessarily tied to the reality of the situation for people. Um, and yeah, so like the equity markets already reflect this, the large inflationary forces. So when you think back to that S&P 500, where you see this massive growth, where it goes, like the prices are flying way above where they were at their peak when things were good, and things are not good and they're flying like by it, then think about that, but in terms of regular goods. So there is hesitation there. And some of the things to think about are, like, people know that this is going to happen. So the governments do have tools that they can use to control money supply. However, decreasing money supply has not been a normal policy for a long time, and the implications of that are also like increasing investment rate or interest rates, which, people are saddled with more debt than they've ever been right now. And what are the implications of that? Right? Like, it almost feels like at every turn, your middle class, lower class families are kind of getting screwed over. So anyway, what are some of the things, if you're a marketing person and you want to aim your company in a new direction, these are the markets that have um, done well throughout COVID-19. Um, I will minimize this so you can see. Uh, so communication technology, Zoom, those things are going to be here to stay. Um, they're it's become such an integral part of our day-to-day life. I know, as someone who works part-time for a company, we have daily meetings on Teams and Zoom, and it's allowed people to work remotely from all over the world. Um, I don't think that's going anywhere. At the same time, there's been or in a similar line of thought, the digitalization of services and education um, has been huge this year. I mean, as as we can tell, we're all taking courses online. Some of us from across the world. Um, it's been a lot bigger in uh, primary and secondary schools, I believe. I think universities are maybe feeling this a little bit less. I know for some programs, med schools, example, or research, they were pretty quick to open up things to go back in class. But for a lot of younger kids, all of their courses have been moved online. And I know in Quebec may be a bit of an exception, where there's been a big push to get kids back to school. I know I'm from Ontario. Um, there's been a large push in Ontario to put things online. I have a bunch of younger cousins who are going through this right now, where they're all um, taking courses online and struggling at home with their parents. Um, so I don't see that. I think there's been such an investment in that it's going to be hard to fully turn away from that. Pharmaceuticals, another big industry, obviously. Vaccines are huge. Even antibacterial stuff has been flying off the shelf. Uh, Similar line, personal protective equipment. things that can protect you and your family. Uh, Things like plexiglass in stores. There was a plexiglass shortage at the beginning of the pandemic, if people remember. That may not last as long, but I believe that after over 9 months, usually from like a neuroscience, neuroplasticity perspective, it takes about 9 months to enter into like a pattern of behaviors. So we've had a pandemic for more than 9 months. The future of this will likely last another 9 months um, after personal protective equipment is no longer required, before people kind of really wean off it. So it might be a short-term market, but not a long-term market. Online commerce, here to stay. I don't think Amazon is going anywhere. Uber Eats, people have again fallen into that pattern. And while it's not a requirement, I think that habit will continue going on. So if you're looking to set up a local delivery service or design apps for um, maybe a local, like creating an amalgamation of local food sources and then pushing that out, that might be an idea. Um, Outdoor recreational activities as well have been through the roof this year. There's been shortages of bikes. It feels like all of my friends are getting into biking these days, which is hilarious. Zwift has been huge, going back to the digitalization. Um, Zwift, if you're not familiar, is an online biking video game, effectively, where you tie your bike a into your sensors, and then that goes into the computer, and you can bike in a digital world, against people as well. There's even races that happen online. And then home renovation and home improvement, that is more of like on the investment side of economics, where you're building value in assets. Um, I don't know if that will increase more, but it's definitely been a thing. So yeah, um, going forward, there's definitely going to be a lot more like vacations. Uh, People are probably going to try to be traveling a lot more. Airlines, maybe look into airlines as a potential expansion idea, since they've been getting pretty hammered. Restaurants, with all of the closures that have happened, if you've wanted to start a new restaurant, now might be the time, uh, especially if there's a lot of vacancies and the demand is returning. And yeah, so yeah, that's. I hope this has been at least interesting, maybe giving you some things to think about, if not directly informative. Um, yeah, all right. Let me know what you think and down below, and good luck with the course. All the best. Take it easy.